Bonds are back, and they are better than ever. After a long period of low interest rates and quantitative easing, fixed income investors are finally seeing a resurgence in the bond market. With central banks raising rates to combat inflation, bond valuations have returned to attractive levels, making them a compelling investment opportunity once again. Take global investment-grade credit, for example. It now yields over 5%, hitting levels not seen since the global financial crisis. This is a huge opportunity for investors who have been starved for yield in the era of low interest rates. Investment-grade bonds have also once again become competitive on a relative value basis, offering income that exceeds the payouts from some of the world's highest dividend-paying stocks. The gap between bond yields and dividend yields has reached a significant level, and this is an indication that bonds are once again becoming an attractive investment option. But today's complex macroeconomic and monetary environment requires prudence from capital allocators. Inflation could prove sticky, and it is not yet clear when the US Federal Reserve or the European Central Bank might call time on their monetary tightening campaigns. Furthermore, the global economy is still relatively weak, which could put pressure on company fundamentals in the more stressed corners of the market, notably low-quality, CCC-rated high-yield bonds. So where should investors go for their first steps back into corporate bonds? One area where yields offer superior compensation against risks is developed markets short-dated credit. Rising interest rates and tightening monetary conditions have resulted in the flattening, and in some segments the inversion, of investment-grade yield curves. The spread between 10-plus-year and 1 to 3-year Eurig bonds has significantly flattened, which means investors can secure higher yields for shorter-dated maturities than for longer-dated ones, while reducing exposure to duration risk. This is crucial in a volatile and uncertain rate hiking cycle. Although shorter maturity high-yield credit also exhibits attractive valuations, the potential for economic distress in the months ahead suggests investors should perhaps focus on high-quality bonds and more defensive industry sectors. Even within investment-grade credit, there certainly is a case for avoiding the more cyclical sectors, such as retail. Defensiveness and a focus on quality are key to navigating today's environment. The investment case for 1 to 3-year investment-grade bonds is all the more compelling as this segment is well placed to deliver attractive returns even if spreads widen further thanks to elevated yields and a lower duration. Expected 1-year returns on global 1 to 3 years IG are quite elevated, which makes it a great opportunity for investors to lock in attractive returns even in an uncertain monetary and macroeconomic environment. Value can also be found at the short end of sovereign curves. In the US, for example, 2-year Treasury bonds are yielding some 70 basis points more than their 10-year peers, a gap not seen for 40 years. Similar trends are in play in Eurozone and Swiss government bond markets. The yield difference between short-dated government bonds and longer-dated ones is quite significant, and this is an indication that short-dated government bonds are a great investment opportunity. As credit investors, adding short-dated government bonds not only enhances diversification, and thus reduces risk, but crucially creates additional sources of return amidst inverted sovereign curves. Adopting a blended credit sovereign approach enables investors to lock in elevated yields while maintaining a lower duration. We believe this is an attractive risk/return proposition during these uncertain times. In conclusion, bonds are back and much better than in the past years.